Hi, it's Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26-year business. It's Wednesday, June 17, 2015, and the title of this week's audio blog is The Immaterial Fed and the End of Europe. Now, it's Wednesday morning as I write, several hours before yet another all-important FOMC policy decision. European stocks are again crumbling, with PIGS bond yields hovering around 9-month highs, as at this point it's hard to believe anyone doesn't realize what's about to occur in Greece, particularly as just this morning the debt committee formed by its Syriza-led government made the following foreboding declaration. Quote, Greece not only does not have the ability to repay its debts to the Troika, but should not repay it at all because debts emerging from the Troika's arrangements are a direct infringement on the fundamental human rights of Greek citizens. Hence, we came to the conclusion that Greece should not pay this debt because it is illegal, illegitimate, and odious. Frankly, the fact European stocks aren't down far more is a tribute to just how powerful the global QE/PPT movement has become. Although, as discussed in yesterday's article, End of the New Normal, the world will undergo a shock far more powerful than 2000 and 2008, when it realized central banks' seeming control over markets was but a figment of their imagination. Unquestionably, the smart money realizes this already, as despite the PPT's ability thus far to prevent the Dow Jones propaganda average from succumbing to the unstoppable tsunami of reality, and conversely preventing gold and silver, i.e. the financial barometers of bad tidings, from rising, nearly all other battles have been decidedly lost. To wit, the final currency war is raging in nuclear fashion, with the average currency having fallen more than 40% since the Fed initiated Operation Twist, QE2 and QE3 in late 2011, including more than 80% for the 4 BRICS currencies not pegged to the dollar. In the commodity markets, many prices have fallen to 2009 spike bottom levels, with the broad CRB index within 7% of breaching the early 2009 low. Economically, the world is in shambles, with nearly all nations at or near their lowest level of activity in decades, in large part due to the aforementioned commodity price plunge, but equally so, the massive deformations, to use David Stockman's term, resulting from the 4 decades of malinvestment caused by reckless, unfettered global money printing. Throw in the explosive growth of the planet's population and an increasingly efficient manufacturing industry, and the gap between jobs available and jobs needed is at an all-time high, growing exponentially with each passing year. To wit, this morning's report that Brazilian retail sales plunged at their highest rate ever, with no less than the vampire squid itself, Goldman Sachs, predicting the disastrous Brazilian economy, one of the BRICS leaders of the global economy, will get far worse. And then, of course, there's the all-time high, parabolically growing debt levels across the planet. Sovereign, municipal, institutional, corporate, or individual, it matters not, as all such groups are in the same boat, having inadvertently fell victim to the siren call of fiat currency-backed monetary systems, which by definition are Ponzi schemes that must grow larger and can never be reduced. Only a precious, lucky few have been able to escape its clutches, by luck or skill, avoiding this murderous trap by increasing their savings whilst avoiding debt and exceeding the vile, sinister corruption of central bank-induced inflation. Sadly, most of said lucky few are the 1% that benefit directly, in my view, immorally and illegally, from said money printing, particularly on Wall Street, in London City, and other financial crime dens the world round. As for the rest of us, we do our best to survive the gathering tsunami of financial repression and economic devastation, knowing full well that hyperinflation notwithstanding, there is essentially no hope of a material economic rebound until the cancerous fiat currency regime grinding it deeper into the abyss is destroyed, which of course mathematically must happen, likely sooner rather than later. Frankly, even I'm astounded by how far-reaching and devastating the unintended consequences of unfettered money printing are, particularly in this, the terminal stage of the largest such Ponzi scheme in global history. For those that believe the political, economic, and social catastrophe we are witnessing today, which will be many multiples more intense in the coming years, is part of some sort of conspiracy, I'd simply say that the impact is far more complex, global, and unpredictable than any group or groups of people could possibly comprehend. or planned for. More likely, we are simply witnessing the cumulative, catastrophic impact of hundreds of trillions of dollars worth of debt, historic industrial overcapacity, out-of-control population growth, and the resulting ever-expanding social and geopolitical tensions. Never before has Occam's razor, i.e., the simplest explanation is the most likely one, been more apropos. And once the big one commences, enveloping not only global economies but previously manipulated financial markets, it will be increasingly apparent that chaos theory is far more relevant than conspiracy theory. Not to mention that the ability to protect oneself from such chaos will be greatly diminished once the games begin. As for today's audioblog title, the reason I chose it is because with each passing day it is becoming more and more apparent to more and more people that central banks have zero ability to predict economic trends, zero ability to improve them, and 100% of destroying all they touch. I mean, geez, you'd think after 7 years of post-2008 money printing, in which the only things that have gone up, aside from manipulated stock and bond markets, are debt, inflation, and social and geopolitical unrest, that the world at large would start to get it. Unfortunately, there are more poor huddled masses than ever who frankly have neither the ability to understand economic complexity or the means to protect themselves from it. And as for the rest, said 1% are more incentivized than ever to do whatever it takes to kick the status quo can as far as possible. Well, it's the equally small subset of society, people like us, have the knowledge, ability, and means to do something about it. That said, we must, just like in 1999 and 2007, watch central bank fostered bubbles expand around us and be treated like Cassandras for simply stating the truth. And even when said bubbles burst, as they did in 2000 and 2008, and will do so far more spectacularly shortly, we will still be ignored and despised, albeit slightly less so. However, it will be us that survive through what's coming and thrive thereafter, even in a world that will likely be far more difficult, dangerous, and uncomfortable. Again, I'm writing this before the Fed's meeting, and don't worry, I'll finish with a summary of their pathetic actions to demonstrate there are far more important issues circling us like vultures with far more dire ramifications than whether or not the Fed plans or doesn't plan to at some point in the future raise the Fed funds rate from a range of 0 to 0.25% to a hard level of 0.25%. Mathematically, raising rates materially is not even a possibility, as doing so would not only burst the historic bubbles in stocks, bonds, high-end real estate, and essentially all financial assets, but destroy the finances of the most indebted nation in global history. Not to mention the most heavily leveraged hedge fund of all time, holding $4.5 trillion of toxic treasury and mortgage-backed bonds with interest rates at all-time lows, and conversely, prices at all-time highs. Yes, the Federal Reserve itself, whose balance sheet now equals 25% of the entire national GDP, which itself is understated by last year's comical additions of non-productive, non-revenue-producing activities due to the government's goal of making the widely watched debt-to-GDP ratio appear lower. And FYI, the last time the Fed's balance sheet reached 25% of the national GDP was in the aftermath of the Fed's post-1929 money printing orgy, after which the stock market proceeded to plunge 50%, whilst the then government-pegged gold price was revalued from $20.67 an ounce to $35 an ounce. I mean, at some point, people will realize the pre-FOMC drift, i.e. the coincidence that more than a quarter of the S&P 500's gains over the past decade have occurred the day before FOMC statements, is nothing but manipulative priming of the market to enable Maestro Greenspan, Helicopter Ben, and Whirlybird Janet the maximum amount of cushion from which to espouse their hyperinflationary policies, lest something go wrong and the market doesn't behave as hoped. This is why the Dow magically rose yesterday amidst a further collapse in Greek negotiations, further horrible economic data, and plunging commodity markets. And this morning as well, with the same exact algorithms supporting stocks as are suppressing precious metals. To that end, it's truly incredible to consider how Zero Hedge, unquestionably the world's best alternative media news source, can see so deeply into the fraud that financial markets have become, yet miss the biggest, most blatant frauds operating right under their noses. For years, I have criticized their shoddy reporting of gold and silver manipulation, which admittedly has improved greatly, but it is still covered with their same air of snarky mocking that the MSM relentlessly deploys to further their sociopathic, self-interested aims. That said, Zero Hedge spends more time focusing on general market manipulation than any other organization, which is why I was astounded when they yesterday published, "Forget the 3:30 p.m. ramp. U.S. stock market gains are all about the 2 a.m. European Eastern Time European Open." Regarding the former, I've been writing of the 3:30 p.m. Eastern Standard Time Hail Mary rallies of the Dow Jones Propaganda Average since Bill Murphy coined the term a decade ago. And as for the 2 o'clock a.m. Eastern Standard Time European Open, it coincides eerily with the 2:15 a.m. smackdown of paper precious metals that has been ongoing for the entire 13 years I've watched them, including 458 of the 522 trading days since the April 2013 alternative currencies destruction raids, in which paper gold and silver prices were bombed one day after the infamous closed-door meeting between Obama and the top too big to fail bank CEOs, during which Goldman Sachs had the gall to issue an unprecedented short sell recommendation on gold, which, by the way, is illegal to do unless you actually borrow the gold first, which I assure you none of Goldman's clients were required to do, probably because it doesn't even exist. That said, there are far bigger issues at stake here than the Fed's inconsequential word cloud, and eventually the petty market manipulations that in time will be swamped by reality, perhaps this summer or fall, as more and more people are starting to fear. Starting, of course, with the Grexit we not only guaranteed 3 months ago in an article of that name, but more than 2 years ago in my initial article on the topic, Greek Tragedy, published in April 2013. Frankly, it's astonishing to realize just how commandeered financial markets have become since the second Greek bailout in February 2012, let alone the first in May 2010. Back then, financial assets plunged and gold and silver surged upon such news, which since then has exponentially worsened, along with the global economy, commodity and currency markets, and geopolitical tensions. Which is why, given the fact that economic Mother Nature never loses, it is so terrifying that we are now amidst the worst economic quagmire of our lifetimes, with government-supported financial assets simultaneously trading at all-time high valuations. And oh yeah, gold and silver trading at their lowest valuations ever relative to the amount of global fiat currency outstanding. Not to mention the lowest ever available for sale inventories and a mining industry on the verge of all-out collapse, care of the financial and human capital starvation it has endured due to 15 years of price suppression, to the point that not only have no material discoveries been made, but current production is operating at a substantial loss. Yes, Greece, which likely, as espoused in a brilliant article by Miss Shedlock this morning titled "Greece Played Germany Like a Violin," has simply been buying as much time as possible since the anti-austerity, read pro-default, anti-euro Syriza party swept into power 4 months ago. Effie is correct, which according to Occam's razor makes complete sense. Alexis Tsipras has been merely pretending to be interested in a new bailout deal in the hope that desperate European bureaucrats would cater to his newly found humility by leaving such a possibility open. Subsequently, Greek citizens have been able to pull tens of billions of euros out of their dying banking system amidst an undisguised run that has prompted the beleaguered National Bank of Greece, which for the past year I have deemed the world's most important stock, to overtly beg for new funding, claiming this morning an uncontrollable crisis featuring soaring inflation would otherwise result. Which frankly, I don't see a chance in hell of occurring, that is, new funding, as neither the Greeks nor the Troika appear to have any remaining resolve to reach an agreement that all parties know will spectacularly fail. And when it doesn't, long before the issue of the sovereign government's 200 billion plus euros of debt, owed mostly to European governments, the ECB and the IMF is even considered, the at least 120 billion and possibly much more of Greek bank liabilities will instantaneously default. And guess who will be on the hook for those gargantuan amounts? For the most part, the government-backed banks of Germany, France, Italy, and Spain, all of whom, with the exception of Germany, are on the verge of economic and financial collapse themselves. Let alone the who knows how many credit default swaps betting for and against a Greek default, or for that matter the countless equally precariously perched emerging market nations whose bond markets will instantaneously implode along with Greece. Or heck, France, Italy, and Spain themselves. And for that matter, wasn't it just a week ago that the co-CEOs of Deutsche Bank were unexpectedly forced to resign, prompting articles suggesting Deutsche Bank, the largest bank in Europe and largest global derivatives purveyor, could be the next Lehman? And then, of course, there's the horrific economic impact to consider, amidst what is already the weakest global economy in generations, with epic stock, bond, and real estate bubbles spanning the globe, from China to Japan, Western Europe, and the king of economic and financial market deformation itself, the United States of global fiat destruction, and the ensuing nuclear proliferation of said final currency war, and the resulting feedback loop of further commodity price implosion and social unrest, geopolitical instability, and of course, additional monetary stimulus as accentuated by the upcoming inevitable Yellen reversal, in which, in stark contrast to the past 2 years' relentless propaganda of recovery, tapering, and imminent rate hikes, Whirlybird Janet will be forced to admit Fed policy is not working, and thus will supplement her words with additional unprecedented QE rounds and likely negative interest rates. To that end, I'm going to end this morning's commentary right here at 11 a.m. Eastern Standard Time, just in time for my weekly Kerry Lutz podcast. After Whirlybird Janet and Co. make their 2 o'clock p.m. Eastern Standard Time policy statement and 2:30 p.m. press conference, I'll be back to relate the pathetic details. Most likely that the Fed continues to diligently watch incoming data for signs that said recovery is improving, and that in the meantime they will maintain their ZIRP policy with the hope/expectation that they might, just might, be ready to increase the Fed funds rate from a range of 0% to 0.25% to a firm 0.25% at their September meeting. Ciao for now, and enjoy your lunch. Okay, it's nearly 4 o'clock p.m. Eastern Standard Time, and after reading the Fed's pathetic statement, all I can think of is the various titles of recent post-FOMC articles and audio blogs I've published. All of the same theme, i.e., the complete and utter lack of credibility these morons have on all imaginable levels. I'll get to the actual pitiful statement written by 120 taxpayer-funded Keynesian lackeys in a second. But suffice to say, the only positive thing about it is that recently the Fed has been merciful enough to reduce its word count, which, as it turns out, only makes it easier for the world to realize how incomprehensibly stupid their exalted governors are. As for Whirlybird Janet's subsequent press conference, the only notable thing to come out of it was her idiotic statement that the Fed, i.e. her, as she was the San Francisco Fed president at the time, should have hiked interest rates faster in 2004 to 2006. Well, Mrs. Sit on your hands during the last housing bubble, when the artificial economy was still strong, the national debt was just $7 trillion versus $19 trillion today, the Fed's own balance sheet had just $700 billion of assets versus $4.5 trillion today, and the CRB commodity index was 350 versus 223 today. What's your plan now? To raise rates into the worst global economy in generations, with unprecedented debt levels growing parabolically, and oh yeah, the surging dollar index destroying U.S. corporate earnings, causing no less than the White House to complain? Of course not, which is why I've all but screamed since QE supposedly ended last October that the Fed could never raise rates, as is history's largest fiat Ponzi scheme worldwide has permanently addicted the global economy to record low rates, in most cases at 0 or below. To that end, QE unquestionably never ended, just as when it was officially occurring, it was far larger than reported. Don't believe me? Then read my December 2013 article, Proof of the Tapering Mirage. In fact, in watching the tectonic market shifts I described in my May 8th audio blog of surging global interest rates despite plunging economic activity, I warned of impending financial disaster if the Fed couldn't manage a way to push rates back down. And not just the Fed, but the ECB, the BOJ, and all the major Western banks watching the cost of servicing their massive debt load surge. Let alone the pigs and other emerging market nations whose rates are surging far faster, as investors finally start to realize that not only was nothing fixed by the ECB's QE program, but things are far worse than ever before, going downhill at a breakneck speed. To wit, European sovereign bond yields are now higher across the board than when the ECB's suicidal 1.2 trillion euro QE program was enacted in March, even after it was increased by another 10% in May. Moreover, aside from last-to-go markets, per the title of a February article I penned, such as the Dow Jones Propaganda Average and paper gold and silver, central banks are starting to lose control of most other markets, from European stocks to global bonds to commodities, currencies, and selected real estate markets. Thus, the Fed knew it must be as dovish as possible today, while it's continuing its laughable effort to save face by pretending all's well. By being as intentionally vague about the timing of potential rate increases as possible, while it's utilizing the ongoing exponentially expanded efforts of its partners in the PPT, Cartel, and Exchange Stabilization Fund, not to mention John Hilsenrath of the Wall Street Journal and Steve Leisman of CNBC, to try to paint its usual propagandized picture. Okay, and now on to the main event of global central monetary planning futility itself. Today's 560 words of kindergarten idiocy from the Federal Open Market Committee, which frankly I have a difficult time discerning from Whirlybird Janet's February Humphrey Hawkins testimony to Congress, which I subsequently deemed the most unequivocally dovish FOMC statement on record. But before I get to the actual wordsmithing, let's give Zero Hedge its due for breaking down the gist of the Fed's dovishness succinctly in stating, quote, while virtually every single word change compared to the April statement shows a Fed that is increasingly more confident in the economy, the dollar plunged following its release, not due to the statement itself, but what is in the Fed's projected materials, where the Fed unambiguously cut its 2015 GDP forecast from 2.3 to 2.7% in March to just 1.8 to 2.0% today, and raised its forecast of the year-end unemployment rate. But nowhere is the Fed's ambivalence more evident than in the latest DOT, or DART as we call them, plots of where every single FOMC member expects the Fed funds rate to be at the end of 2016. The wholesale drop in expectations from 1 7/8% in March to 1 5/8% currently clearly suggests that while most committee members claim that the first rate hike should be in 2015, their conviction is even lower than 3 months ago. Yes, and far lower than when the aforementioned most unequivocally dovish FOMC statement was published in February, and dramatically lower than in December when Whirlybird Janet predicted the first rate hike would be in March, i.e. 3 months ago. Which is why it's so comical that anyone believes a word these biased, idiotic hacks say. And more so, why even Zero Hedge suggests the statement is, quote, laying the groundwork for a September rate hike. I mean, why September? Because the Wall Street odds are on it? Because something great will happen this summer, enabling history's most overvalued markets and most over-indebted economies to survive the ensuing shockwaves of higher rates? And what if one of 1,000 scenarios, one more negative than the next, occurs, such as a Greek default, additional commodity or currency crashes, heightened geopolitical tensions, or a plain old continuation of the horrific global economic trends that are far more likely than not than the elusive recovery that never arrives? But don't worry, the all-powerful FOMC has a built-in excuse for every imaginable negative scenario, sort of like those over-the-counter drug commercials warning you that the product may cause severe side effects, including death. To wit, quote, the committee will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and expectations, and readings on financial and international developments. In other words, if anything goes the wrong direction, no matter how large or small, they can use it as an excuse to maintain ZERP. And if it's bad enough, which to a man is a far safer bet, they can take ZERP to NERP and shock in all the world with unprecedentedly large rounds of QE. And now, on to the changes in the June statement relative to April, which on balance depict the Fed with not a clue what it's doing, simply reading the news like you and I, stating the obvious, and either concluding the, quote, the economy strengthened, or the economy weakened, but we expect it to strengthen. Followed, of course, by the obligatory aforementioned reduction in quantitative measures like GDP and future Fed funds rate expectations, counting on their myriad propaganda partners to toe the party line, like their mouthpiece, John Hilsenrath, who lied through the Fed's teeth in stating, the Federal Reserve signaled it was moving toward interest rate increases in the months ahead, now that signs of a dip in the economic activity earlier in the year are waning. As for said changes in the statement relative to April, they started by changing, quote, since the March meeting, economic growth slowed during the winter months, in part due to transitory factors, to, since the April meeting, economic activity has expanded moderately after having changed little in the first quarter. Wow, how profound, particularly as it is a blatant lie, as since the end of March, essentially all economic data has significantly worsened, other than a handful of blatantly transparent island of lies reports like the May NFP employment report. And as for said transitory factors, what exactly are they? And are they still in the process of transit? Are we speaking of the oil price, which at $59 per barrel is still so low, the rig count has gone down every week since? Next, they changed April's "the pace of job gains moderated" to "the pace of job gains picked up." Wow, even more profound, especially as it is pure BS, corroborated by nothing but the government's own easily disproved economic lies. Up next, April's, quote, "a range of labor market indicators suggest that underutilization of labor resources was little changed," to "a range of labor market indicators suggest the underutilization of labor resources diminished somewhat." Of course, despite such diminishing of labor resource underutilization, the FOMC increased its expectation for the year-end unemployment rate. Next, several lines of gibberish about other economic factors, ending with, "however, business fixed investment stayed soft." And of course, the boilerplate language regarding inflation being too low, which as you can imagine never changes. And oh yeah, I forgot the only other change in the entire statement relative to April, which General Custer himself would be proud of, to wit, energy prices appear to have stabilized, which I'm not even going to comment on given its sheer idiocy. Not to mention the fact that Whirlybird Janet is officially on the record claiming that both higher and lower oil prices are positive for the economy. Throw in the completely unchanged language that, quote, "the committee continues to see the risk to the outlook for economic activity and the labor market as nearly balanced. The committee continues to monitor inflation developments closely, and the committee anticipates it will be appropriate to raise the target rate for the federal funds rate when it sees further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term." And you have an unambiguously dovish statement with absolutely no change in outlook and not even a hint of expectation about tightening monetary policy. Much less in September, as John Hilsenrath and Steve Leisman have been ordered to propagandize. Until, of course, we get to September, when, assuming the world hasn't yet collapsed or the Shemitah is actually real, they start to discuss December as the rate hike time, or March, June, or September of 2016. Well, the market is now closed, and blatant cartel capping and all, gold closed up $5 an ounce, which is exactly the amount the cartel smashed it down before the FOMC release. Silver ended up 15 cents, and the Dow 30 points. Whilst the 10-year Treasury yield closed where it started the day, at 2.32%, although it was up to 2.40% just before the FOMC announcement. And what's this? On a day when Greek stocks and bonds were again hit hard by news that a Greek default and Grexit appear imminent, the dollar plunged against the euro, as well as nearly all currencies. What does that tell you about the market's expectations for future Fed monetary policy, my friends? Not to mention the further plunge in commodities, signaling expanding global economic weakness. Okay, I think I'll conclude on that sour note, that the time is now, with precious metal prices suppressed well below the cost of production, amidst record global demand and a list of potential positive catalysts a mile long, to protect your assets from what's mathematically certain to be arriving shortly. Not to mention the ominous prospect of peak gold staring us in the face, as discussed in this week's must-read article, "Mining Industry Implosion Approaches DEFCON 1." To that end, for those considering the purchase or storage of precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much.